In trading, the first trap that captures almost everyone is the belief that knowledge equals success. It feels logical to assume that if you study enough charts, read enough books, watch enough tutorials, and follow enough market news, you'll gain a decisive edge over others. And yet, despite this constant hunger for information, the statistics remain merciless. The majority still lose money. The illusion lies in mistaking accumulation of knowledge for the mastery of application. Knowledge fills the mind with concepts, but without the right mindset to filter, structure, and act on that knowledge, it becomes noise. Winners understand this difference deeply. They know that information in trading is abundant and cheap, but wisdom, the ability to apply that knowledge in the heat of the market, is rare and costly. The 99% crowd tends to believe that the next piece of information will change everything. They think the missing puzzle piece is out there waiting to be found, the perfect indicator, the perfect news feed, or the ultimate strategy someone else has discovered. They jump from one course to another, one mentor to another, one signal service to another, always chasing the illusion of certainty. Winners, on the other hand, step away from this cycle. They recognize that the more you chase external sources of knowledge, the more you dilute your own decision-making. Instead of chasing everything, they sharpen their focus. They learn that less is more. A few well-chosen principles, applied consistently, beat 1,000 fragmented pieces of information. This illusion is powerful because markets are noisy by design. Headlines shout at you daily. Gurus shout louder, and social media makes every movement look like an opportunity you're missing. It's easy to believe that if you just knew what the insiders know, you'd be in the winner's circle. But winners don't win because they know more facts. They win because they interpret the same facts differently. When 99% see panic, a winner sees structure. When 99% react to news, a winner pauses to ask how the market as a whole is reacting. Not just what the news headline says. The difference isn't in the knowledge itself, but in the mental framework applied to that knowledge. Think of knowledge as raw material. If you hand steel to one person, they might see only its weight and cost. Hand it to a skilled builder, and it becomes a bridge. In trading, knowledge is raw material too, but without the builder's mindset, it never becomes a bridge to success. The average trader fills notebooks with strategies they never test properly, charts filled with lines they never truly understand, and journals they never review. Winners, in contrast, strip things down. They might use one or two indicators consistently, understand their strengths and weaknesses, and master them like craftsmen. They don't chase every new tool. They refine the few tools they trust. Another layer to this illusion is overconfidence. Knowledge makes you feel smart, and in markets, feeling smart is dangerous. The more facts you gather, the more certain you become, and the more risk you tend to take. But the markets punish arrogance swiftly. Winners understand that their edge isn't about being the smartest, it's about being the most prepared and the most disciplined. They know they cannot predict everything, so they build systems that work despite uncertainty. They embrace probabilities over predictions, process over ego. The 99% mistake knowledge for certainty, but winners use knowledge only to frame risk in uncertain conditions. This also explains why two traders can look at the same chart and see completely different things. Both have knowledge of candlesticks, patterns, and support levels, yet one panics while the other waits calmly. The difference lies in mindset. Knowledge tells you what happened, but mindset decides what you do next. Knowledge shows you a red candle. Mindset determines whether you view it as danger or opportunity. Knowledge explains volatility. Mindset determines whether you survive it or drown in it. Winners know that their edge is not in the data itself, but in their ability to remain calm, disciplined, and structured when applying it. The illusion of trading knowledge also ties into the endless hunger for complexity. Many traders believe the market is too complex for simple approaches to work, so they chase complicated algorithms, multi-layered indicators, or exotic trading systems. But winners know that complexity often hides weakness. Simplicity reveals strength. A clean, simple system, mastered through discipline, beats a complex system that overwhelms the mind. The majority see complexity as a sign of sophistication, but winners seek simplicity as a sign of clarity, and clarity is what separates those who survive from those who drown in information. In the end, winners free themselves from the illusion by shifting focus from accumulation to execution. They stop asking, "What don't I know yet?" and start asking, how well am I applying what I already know? They stop trying to be walking encyclopedias of market theory and instead focus on becoming masters of their own behavior in the market. They realize that the real edge is not found in another book, another video, or another system. It is forged through patience, discipline, and practice in applying the basics with precision over and over again. Trading is not simply a game of numbers, charts, and probabilities. It is a battlefield of human emotions. The majority of traders, the 99%, walk into this battlefield with no armor. They let fear, greed, excitement, and frustration dictate their every move. When prices rise quickly, they feel the adrenaline and rush in too late. When markets fall, fear grips them, and they exit at the worst possible moment. Their accounts are not destroyed by lack of knowledge, but by the inability to regulate emotions. Winners, however, separate themselves by cultivating emotional neutrality. They trade with calmness, not indifference, but a deliberate state where emotions don't hijack their judgment. They understand that the market is designed to exploit emotional reactions, and by mastering neutrality, they place themselves outside the trap that catches nearly everyone else. Neutrality does not mean you feel nothing. It means you don't let feelings dictate action. A winner might feel the same fear when a trade goes against them, but instead of reacting impulsively, they pause and let their system dictate the response. They might feel the same excitement when a trade explodes in profit, but they don't double down recklessly or abandon their risk rules. Emotional neutrality is the ability to witness the emotion without letting it pull your hand to the mouse. It is a shield against impulses that wreck consistency. For the 99%, emotions are the driver, and logic is the passenger. For the winner, logic drives while emotions sit quietly in the back seat. This is why winners view trading, not as a test of intelligence, but as a test of control. The average trader often believes that if they can just think faster, analyze better, or learn more strategies, they'll succeed. But intelligence alone is useless when your emotions override it in the moment of execution. How many times have traders told themselves, next time I won't chase, next time I'll stick to my stop, next time I'll be patient? And yet, when the market moves, they break their own promises. This cycle happens because emotions override prefrontal logic. Winners train themselves differently. They accept emotions will arise, but they build structures and habits that neutralize them in real time. This is the unseen advantage that separates them. One of the key aspects of emotional neutrality is detachment from money in the moment. The majority tie every tick in price to their sense of wealth and self-worth. A losing trade feels like personal failure, while a winning trade feels like validation. This emotional roller coaster makes consistency impossible. Winners, however, view money as points in a probability game. They know that no single trade defines them. They view losses as business expenses and gains as business revenue. This perspective breaks the emotional link between self-identity and market outcome, giving them the space to remain neutral in execution. They understand the game is about hundreds of trades, not the outcome of one or two. Emotional neutrality also means refusing to be seduced by greed. Greed is subtle because it often disguises itself as confidence. The majority of traders ride a winning trade and suddenly feel invincible. They abandon their plan, increase their size, or start chasing more trades with the belief that the market owes them. This is how many accounts that looked strong in the morning end up destroyed by the evening. Winners feel the same temptation but recognize it as danger, not opportunity. They lock in profits systematically, scale responsibly, and treat a winning streak with the same neutrality as a losing streak. For them, one win or one loss means nothing compared to the discipline of repeating their edge over time. Fear, on the other hand, paralyzes the 99%. A trader sees a perfect setup, but hesitates because they lost on the last trade. The candle moves, the opportunity passes, and regret compounds. This cycle repeats until fear becomes their default response. Winners reframe fear as information. Instead of avoiding trades, they ask, is my fear telling me something valid about risk, or is it simply the echo of my last loss? By asking this, they can separate real market signals from psychological noise. Neutrality gives them the strength to act when needed, and the patience to wait when not. They no longer allow fear to sabotage opportunities, but use it as a signal to double-check their process. Another layer of neutrality is handling frustration. The majority become emotionally tilted after losses, trying to win back money through revenge trading. They abandon discipline in an attempt to erase pain. This is the point where many accounts implode. Winners never let frustration drive action. They take breaks, step away, or reduce size until emotions cool down. They know trading, while tilted, is like driving drunk. It feels urgent, but it's reckless and destructive. Their neutrality comes from having the humility to walk away when emotions are too strong. The market will always be there tomorrow, but their capital may not if they trade in anger today. Ultimately, emotional neutrality is not something that happens naturally. It is trained like a muscle. Winners use routines, checklists, meditation, journaling, and deliberate self-reflection to strengthen it. They replay trades not just to analyze market signals, but to analyze their own psychology. They study their emotional patterns as carefully as they study price patterns. While the 99% look outward for edges in charts and indicators, winners look inward for edges in control and mindset. This internal mastery transforms trading from a chaotic emotional experience into a calm, deliberate execution of probabilities, and it is this inner calm that the market cannot exploit. In trading, patience is not passive. It is one of the most aggressive edges a trader can have. Most traders enter the market with the belief that constant action equals progress. They think the more trades they take, the faster they will grow, the quicker they will reach success. But this belief is the silent destroyer of accounts. The market punishes impatience more brutally than any other flaw. The 99% can't resist clicking the button, can't resist chasing a move, can't resist being in the game at all times. The winners, on the other hand, transform patience into a weapon. They wait with the precision of hunters. They understand that doing nothing is often more profitable than doing something. Patience allows them to conserve both capital and emotional energy until the exact moment when probabilities align in their favor. Patience is not easy, because the human mind is wired to seek activity. When the screen is flashing, when price is moving, when other traders are posting wins online, the urge to act becomes overwhelming. This is where the majority fall into the trap. They convince themselves that a mediocre setup is good enough, or that they will miss out if they don't take the trade. Winners train themselves to resist this impulse. They understand that mediocre trades drain focus, damage confidence, and slowly erode capital. By refusing to settle, they preserve strength for the moments when the edge is undeniable. Their patience is an active defense against mediocrity. A powerful example is in breakout trading. The majority can't wait for confirmation. They jump in at the first sign of movement, only to get trapped in false breakouts and sharp reversals. The winner, however, watches the same chart but remains still. They wait for volume, structure, and alignment across multiple time frames. They wait for the market to prove its intent. When they finally act, they do so with clarity and conviction, while the impatient traders are already bleeding from early entries. The difference is not in knowledge of breakouts, but in the patience to wait for the right one. Patience also plays a role in risk management. The majority are impatient to recover from losses, so they increase size, force trades, and spiral into bigger drawdowns. Winners do the opposite. They wait for conditions to reset. They wait for their own mind to cool. They wait until the edge reappears, no matter how long it takes. This patience keeps their capital intact and their mindset sharp. They know that forcing recovery is suicide, but allowing recovery through patience is survival. The market rewards those who can wait for the storm to pass before sailing again. The irony is that impatience often feels like productivity, while patience feels like stagnation. The 99% believe that if they are not trading, they are not progressing. But winners understand that progress in trading often happens in silence. Watching the market without acting strengthens discipline. Journaling trades and reviewing setups builds insight. Sitting on the sidelines teaches restraint. Patience is not wasted time. It is investment in readiness. It is sharpening the blade rather than swinging it wildly. The winner's account grows not because they are always active, but because their activity is perfectly timed. Patience also creates psychological distance from the market. The majority are constantly entangled, reacting to every tick, unable to step back. Winners give themselves space by waiting. They learn to detach from noise, to let others chase while they observe calmly. This distance allows them to see bigger patterns that impatient traders miss. They are not trapped in the minute-to-minute chaos, but positioned to act on the larger flow of probabilities. In this way, patience elevates perspective. It allows winners to think strategically rather than emotionally. The weapon of patience extends beyond trade entries and exits. It shapes the entire career of a trader. The majority seek shortcuts, desperate to master trading in months. They jump strategies, change systems, and burn through capital, all because they cannot wait for the compounding of skill. Winners know mastery takes years, and they embrace this timeline. They have patience with themselves, patience with the process, and patience with growth. This long-term patience ensures they survive the brutal early years while others give up. The same mindset that waits for the perfect setup in a single trade also waits for the gradual evolution of success across thousands of trades. Another dimension of patience is silence during uncertainty. The 99% hate uncertainty, so they force answers, forcing trades where clarity doesn't exist. Winners embrace uncertainty with patience. They understand the market does not owe them a trade today, or even this week. They can wait in cash, while others bleed in chaos. They treat cash as a position, patience as a trade. This mindset shifts the balance of power. The impatient trader feels dependent on the market to provide opportunities. The patient trader controls when they engage. By waiting, they dictate terms rather than reacting to randomness. Ultimately, patience is a weapon because it removes the trader from the rhythm of the crowd. The crowd acts now, fears now, chases now. The winner waits. When the crowd is exhausted, trapped, or wrong-footed, the patient trader strikes with precision. Their edge does not just come from analysis, but from the discipline to. In the world of trading, nothing separates winners from the majority more clearly than how they deal with losses. For the 99%, a loss is devastating. It is an attack on their confidence, their identity, and often their sense of worth. They see a red trade as a personal failure, a sign that they are not cut out for this game, and the emotional pain drives them to make reckless decisions. Some double down in anger to win back what was lost, while others retreat in fear, avoiding the next valid setup. Both paths lead to destruction, because both are emotional responses to an inevitable reality. Losses are a permanent part of trading. Winners, however, take a completely different view. They embrace losses as lessons, treating each one as tuition paid to the markets. They understand that no trader, no matter how skilled, wins every time. Instead of resisting this truth, they accept it fully and use it as fuel for growth. This mindset shift is profound because it changes the very nature of how losses are experienced. For the 99%, a loss feels like the end of something. But for winners, a loss is the beginning of understanding. It is a data point that provides feedback. It tells them where their system might need refinement, where their psychology wavered, or where the probabilities simply didn't align. Instead of dwelling on the pain, they study the cause. Was it a valid setup that simply didn't work out? Or was it a trade taken outside the rules? Was it driven by patience and discipline or by impulse and fear? By asking these questions, winners transform losses into valuable teachers, while the majority let losses become scars that bleed confidence away. This difference in perception creates a huge gap in long-term growth. The average trader avoids reviewing losing trades because it hurts too much to face them. They scroll past them in their journals or try to forget them entirely. But this avoidance guarantees repetition of the same mistakes. Winners, by contrast, lean into the discomfort. They dissect losing trades with the same intensity as winning ones. They know that every mistake left unexamined becomes a repeated mistake, and every repeated mistake compounds into disaster. Reviewing losses is not optional. It is part of their training. By consistently learning from each one, they gradually eliminate weaknesses, refine their edge, and build a system that grows stronger with time. Embracing losses also changes how winners perceive risk. The majority fear risk as something dangerous, something to avoid or escape. This fear leads them to tighten stops too much, miss opportunities, or sabotage trades before they can work. Winners, on the other hand, accept risk as the cost of playing the game. They never expect certainty. They expect probabilities. They know that even the best setups carry the possibility of loss, so they size positions accordingly. When a loss happens, it is not a shock but an expected outcome within their framework. This acceptance of risk makes them unshakable, while the 99% are constantly shaken by every losing tick. Another critical aspect of embracing losses is emotional balance. For the majority, a loss creates frustration that leads to revenge trading, where they recklessly try to win back what was lost. This is the path to ruin. Winners avoid this spiral because they've redefined the meaning of loss. It is not a personal insult, not something to avenge, but simply feedback. They take the hit, record it, and move forward without emotional baggage. This ability to reset quickly keeps their minds clear and their decision-making sharp. The 99% dwell on the last trade, while the winners are already focused on the next opportunity. Losses also teach humility, and humility is the shield that protects winners from overconfidence. Many traders get destroyed not by their first series of losses, but by their first series of wins. A streak of good trades makes them feel invincible, leading them to increase size recklessly or break their rules. Losses pull winners back to reality, reminding them that the market is bigger than any individual. By embracing losses, winners stay grounded. They treat both wins and losses as temporary, knowing that the only thing that matters is discipline and consistency across the long run. Humility keeps them alive in a game where arrogance kills account. Over time, the practice of embracing losses builds resilience. Each loss faced, reviewed, and learned from strengthens the trader's mindset. Resilience is not about avoiding pain, but about enduring it without breaking. The 99% crumble under pressure because they never build this resilience. Winners thrive because they use every setback as training. They do not see a losing week or month as failure, but as part of the process of mastery. They know that the long-term game belongs not to those who never lose, but to those who can lose, recover, and come back sharper each time. Perhaps the most powerful outcome of embracing losses is freedom. The majority trade in constant fear, fear of being wrong, fear of losing money, fear of looking foolish. This fear paralyzes them and clouds their judgment. Winners are free from this fear because they have accepted losses as inevitable. They no longer need to prove anything to themselves or to the market. Each loss is simply data, nothing more. This freedom allows them to trade with clarity, patience, and confidence. While the 99% are shackled by the weight of fear, winners move lightly, able to see opportunities clearly and act decisively without hesitation. One of the defining traits that separates winners from the vast majority of traders is their ability to detach from the outcome of any single trade. The 99% live and die with each result. A winning trade makes them euphoric, convincing them they've finally cracked the code of the markets. A losing trade drags them into despair, shaking their confidence and often leading them to abandon their plan entirely. Their emotions rise and fall with every tick of profit and loss, and because of this, they never achieve stability. Winners approach the market from a completely different angle. They view each trade as one event in a long series, nothing more than a single data point in a probability distribution. They understand that success is measured over hundreds of trades, not one, and by detaching from outcomes, they create the consistency that the 99% can never reach. This detachment does not mean they don't care about results. It means they care more about process than about any single outcome. The majority define themselves by the money they make or lose today. If they win, they feel validated. If they lose, they feel inadequate. This constant emotional swing blinds them to the bigger picture. Winners instead define themselves by whether they followed their rules, respected their risk, and executed with discipline. If they placed a trade exactly according to plan and it lost, they count it as success because they know the plan works over time. If they broke rules and still won, they view it as failure because luck is not repeatable. This shift in measurement frees them from the emotional roller coaster of outcomes and anchors them in the stability of process. The danger of being outcome attached is that it creates distorted decision making. A trader who desperately needs today's trade to be a win will hesitate, doubt, or interfere with their strategy. They will move stops, exit early, or avoid setups altogether out of fear of loss. Their mind is so focused on the result of this one trade that they lose sight of the larger probabilities. Winners, detached from this obsession, treat every setup the same. They execute calmly, knowing the math plays out over time. Their detachment allows them to trade with clarity, while the 99% suffocate under the weight of short-term thinking. This mindset also transforms how winners deal with losses. The average trader ties personal identity to results. A losing trade makes them feel like failures, as people, not just as traders. This emotional burden leads to revenge trading, self-doubt, or quitting too soon. Winners, detached from outcomes, never take a loss personally. It is simply one roll of the dice in a game of probabilities. They have accepted that losing is built into the structure of trading, so they feel no shame when it happens. This frees them from the paralysis that grips the night. They can move to the next trade without carrying the baggage of the last one, maintaining mental clarity throughout. Detachment also protects against the danger of overconfidence. Winning streaks are just as dangerous as losing streaks when a trader is outcome attached. A string of wins makes the majority feel invincible. They increase size recklessly, abandon rules, and believe they have outsmarted the market. The result is almost always catastrophic. Winners, by contrast, remain even-keeled. A winning streak doesn't inflate their ego because they know it is part of the statistical distribution, just as losing streaks are. Detachment keeps them grounded, humble, and focused on process, not seduced by temporary success. This is why they are still standing long after others have been blown out. Another layer of detachment is the way winners view money itself. The 99% see money emotionally. Profits feel like validation. Losses feel like punishment. Winners see money as inventory in a business. It is capital to be risked strategically, not a measure of self-worth. They don't need every trade to win, just as a shop owner doesn't need every product to sell. They need the overall process to remain profitable. This perspective makes them immune to the panic and greed that drive the majority. It allows them to risk rationally, to let trades play out without interference, and to avoid sabotaging themselves through emotional attachment to dollars and cents. Detachment from outcomes also allows winners to embrace uncertainty rather than fight it. The 99% crave certainty. They want every trade to work, every strategy to be perfect, every decision to lead to profit. This craving is why they chase new systems endlessly, hoping to find one that never loses. Winners have abandoned this illusion. They know that uncertainty cannot be eliminated. It can only be managed. By detaching from the need for certainty in outcomes, they focus on what they can control: risk management, execution, and discipline. This gives them peace in a game that drives others to constant frustration and exhaustion. Over time, this detachment builds incredible psychological resilience. The average trader burns out emotionally because their mood is tied to short-term results. Every loss is crushing, every win fleeting, and the cycle wears them down. Winners sustain themselves for years because their emotions are not chained to outcomes. They trade with balance, with a clear head, with patience that comes from knowing no single trade matters. This resilience allows them to stay in the game long enough for skill and compounding to take effect, while the majority quit before they ever reach that stage. The secret to trading longevity lies here. Detachment from outcomes shifts focus from needing to be right to needing to be consistent. The market does not reward perfection. It rewards persistence. Winners stay persistent because they are free from the emotional highs and lows that crush the majority. They do not let one trade define them, one day define them, or even 1 month define them. They measure success over the arc of their journey, not the outcome of a single step. And because of this detachment, they build a level of consistency and endurance that the 99%. Conviction is the invisible force that separates those who merely participate in the markets from those who rise above the crowd. The 99% enter trades with hesitation, doubt, or blind hope, and their actions show it. They second-guess entries, exit too early, or hold on too long because they don't truly believe in their own process. Winners are different. They step into trades with conviction, not arrogance, but confidence rooted in preparation. Conviction is not built on random hunches or emotional impulses. It is the product of discipline, structure, and clarity. It is the internal certainty that regardless of the outcome of this particular trade, they have executed a system that has been tested, trusted, and proven to work over time. This inner game begins long before a trade is ever taken. For the majority, trading decisions are made in the moment, based on what the market feels like or what they saw someone post online. Their lack of preparation leaves them vulnerable to the chaos of the present moment. Winners, however, cultivate conviction by building their edge away from the heat of the market. They test their strategies extensively, record their results, and refine their methods until they know them inside out. When it comes time to trade, they don't rely on guessing. They rely on a foundation of evidence. This preparation transforms uncertainty into manageable probability, and probability into conviction. They no longer wonder if their setup works. They know it does because they've proven it through work and discipline. Conviction also shows in the way winners execute. The majority hesitate at the moment of entry. They let fear whisper that maybe this isn't the right time, or maybe they should wait for just one more confirmation. By the time they act, the opportunity has often passed, or they enter late and expose themselves to greater risk. Winners do not hesitate. Their conviction allows them to pull the trigger when the signal is clear, because they have already decided in advance what qualifies as a valid setup. They don't need to negotiate with themselves in the moment. The decision has already been made through preparation, and conviction gives them the strength to follow through decisively. Once in a trade, conviction becomes even more critical. The 99% often exit prematurely at the first sign of fluctuation. They watch every tick with nervous eyes, and when price moves slightly against them, they panic, assuming they were wrong. Winners hold firm because conviction anchors them. They know fluctuations are part of the game. They know their stop loss defines their risk, and as long as that risk hasn't been breached, the trade is still valid. This confidence allows them to let trades play out fully, capturing moves the majority never experience because they are too busy jumping in and out emotionally. Conviction gives them patience in the storm and discipline in the face of noise. Conviction is also what allows winners to manage risk with precision. The majority either risk too much out of greed or too little out of fear, constantly shifting their size based on emotions. Winners, guided by conviction, risk the same calculated amount consistently. They do not need to gamble because their edge is proven. They do not need to under-risk because they are afraid. Their conviction in their process allows them to treat every trade with the same discipline, regardless of outcome. This consistency is the backbone of long-term success, and it comes only from the inner certainty that their plan works over time. Another powerful element of conviction is resilience during losing streaks. The 99% collapse after a few losses in a row. They abandon their system, jump to new strategies, or quit altogether, convinced the market has turned against them. Winners endure because conviction holds them steady. They know losing streaks are part of probabilities, not proof that their edge is broken. Because their conviction is rooted in preparation and evidence, they trust their plan even when results temporarily falter. This resilience allows them to survive the inevitable drawdowns that destroy less prepared traders. Conviction shields them from despair and keeps them aligned with their long-term vision. Conviction also manifests in independence. The majority are easily swayed by outside voices, news headlines, social media, gurus, or the opinions of friends. They doubt their own judgment and constantly seek validation from others. Winners operate differently. They may consume information, but their decisions come from within, from the conviction built through their own process. They do not need the approval of others to act, nor are they shaken by conflicting opinions. Conviction frees them from the noise of the crowd and keeps their focus sharp on what they know works. This independence is why they can remain calm when the majority are swept away by collective panic or euphoria. Perhaps the most important part of conviction is that it transforms fear into focus. Fear is natural in trading. It arises whenever money is at risk. But fear cripples those who lack conviction, while it sharpens those who possess it. Winners do not eliminate fear. They channel it through the confidence of preparation. Their conviction reminds them that risk is defined, their system is sound, and their edge is real. Instead of paralyzing them, fear becomes a reminder to respect their plan. This balance of fear and conviction creates a powerful mental state. Alert but not anxious, confident but not careless, decisive but not reckless. At its core, conviction is not about predicting outcomes with certainty. It is about trusting your process enough to execute, without hesitation, regardless of what happens next. The majority cling to each trade as if it must work. But winners know that no single trade matters. Their conviction lies in the bigger picture, in the long series of trades, where probabilities unfold in their favor. This inner game keeps them grounded, calm, and decisive in a world that constantly tests resolve. Conviction, born from preparation and discipline, is the quiet force that elevates winners above the doubt, hesitation, and inconsistency that trap the